morning, I'm Chris Beach and welcome to Charting the Markets on IG Live. It's a bit of an interesting day so far. Early gains for indices being erased as the session moves into the middle of the morning. Obviously, US markets back in action after their holiday yesterday, so the liquidity has returned overnight. You had another tough session for Asian markets more than anything else, really. We did have, of course, that rate cut, yet another rate cut, of course, from China, easing their benchmark lending rate by about 10 basis points. But really, that was viewed as not enough to provide confidence in the outlook and whether the action will actually have any positive effects. So once again, you had equities retreating. After, of course, it must be said, what was a fairly good week for risk assets. You did have the Fed meeting the ECB, and markets navigated that relatively well, it has to be said. But of course, we've gone straight from those two events and the Bank of Japan, to be fair, into another series of high impact events, most notably, of course, Jerome Powell and his testimony to Congress on Wednesday and Thursday. So markets are once again taking it as an excuse just to rein in any risk appetite ahead of that testimony, because there's a possibility, of course, that the head of the Federal Reserve might look to provide some more information, some more colour, some more detail on the Fed's thinking on monetary policy at this point in time, and the decision, of course, to increase their forecast for US interest rates to the end of the year, which essentially signalled that we could see leaves room for another 2 interest rate hikes into the end of the year, which still seems unlikely. I think if you look at the reaction in the US dollar, certainly in the wake of the Fed, it does suggest the market doesn't really believe them, but it's enough to give people pause, I think, really. And not just the Fed this week, not just Jerome Powell this week, rather, also UK CPI tomorrow, and then, of course, the Bank of England on Thursday. And with so much focus on the UK mortgage market and what's going to happen there, undoubtedly this could be quite an interesting meeting, especially for sterling. Starting with indices, beginning with the FTSE 100, which currently trades at 75.85, and you can just see we did move above 7,600 in the early part of the session today, but we've been unable to hold on to those gains, and that's a pattern we've seen replicated across markets, particularly in Europe. US futures also giving back some of their early gains. And so the problem with the FTSE 100 is, of course, you've started to look like you've got this downtrend in place here. You've got a lower high here on 23rd of May, and then one also on Friday, where the index rallied to its highest level since 24th of May, but couldn't hold those gains. That was an interesting and negative development, certainly, for the index, and really sort of has given the sellers the upper hand for the time being. This downward move from those April highs is continued, which, of course, in and of itself was a lower high after the February record high for the FTSE, up at 8,045. For the buyers, the consolation would be that we had a bounce off trendline support from the May low, right at the end of the month, actually into the end of May. Ended poorly, but May ended poorly rather for the FTSE, and then we bounced into June. But that bounce has fizzled out for the time being. But it is holding trendline support from the October lows. You can see the trend line that held back in March as well. So that in itself is perhaps an encouraging sign for buyers. We are still above the 200-day moving average as well, but in this no man's land, really, with 50 and the 100-day moving averages declining and the price below it, it's not really a great place to be for either side, because certainly the sellers have had their own way since the highs in April, more or less, of course. But it hasn't really obviously broken these May lows, and of course has more support potentially down at 7,300 for the index. Of course, not really continuing on that strong start to the year, the FTSE. So it's gone from being the star performer of the year, one of the star performers of the year, to being a middling performer at best, overtaken, of course, by the likes of NASDAQ and indeed the DAX as well. Turning to the DAX, that one's taking a knock for the second day in a row. Monday wasn't great for European markets. Tuesday has not been much better so far. Of course, it does come off the back of this huge rally from those March lows, which is still intact. It's just that we've seen the price really struggle to move higher in the shorter term. We find ourselves back at not below 16,000 yet, but certainly heading in that direction. Nonetheless, whereas for the FTSE 100, we saw it was above the 200-day, but below the 50 and the 100-day moving averages, both of which were declining. Here, you've got a price that's above the 50, above the 100, and above the 200, needless to say. And crucially, the 50 and the 100-day moving averages are moving higher. So just in a sort of simple trend analysis, you can see that the price is still in an uptrend. We did clock up a new higher high last week. So the buyer is still more or less in control. It's not certainly not an argument at the moment to say that the DAX has topped and that's it, really. Just seeing some weakness coming through that might continue in the short term. Of course, we can't tell, but this is what we're watching for, this weakness coming through. Definitely one thing to watch. Trendline support, again, from December lows this time, which supported the index during the course of that March banking crisis and was briefly tested right at the end of May as well before the index bounced once again. So interesting times here, but the buyers still just about in control over the medium term. It's just they haven't been able to drive this one higher over the past couple of days. And then turning, of course, to the Dow, everyone's favorite index, really. This one did reach, actually, if you look on Friday, it did reach its highest level since December on Friday, breaking above 34,500. Excuse me. And then just, but like the FTSE, being unable to hold those gains and dropping back yesterday in very thin trading and slightly weaker this morning. It's kind of what you expect to see after a US holiday anyway. You had a good run up the previous 2 weeks or so. We were down at 33,500 on the 6th of June. We then found ourselves 1,000 points higher just over a week later. Some kind of pullback isn't unexpected, really, I think. Nonetheless, it's a slightly worrying sign in the short term, perhaps, that maybe some jitters will dominate until Jerome Powell gets out of the way. This week, Wednesday's testimony is always the more interesting or the more market moving. By the time he gets to Thursday, he's probably said all the interesting things he's going to say, famous last words. But that's what, certainly tomorrow could be the one where we could see some volatility creep into the Dow, to the Nasdaq, the S&P, and of course dollar assets as well. So do bear that one in mind. So I think for the indices, FTSE 100 fairly mixed. The Dow still, the DAX rather still relatively positive, and the Dow more positive. I think the FTSE 100. The fact that it's above the 50 and the 100-day moving averages is another strong sign. Currency markets have seen the dollar try and recover over the past couple of days, and it's trying to do that once again this morning. But you can see with euro dollar, it's a bit mixed at best. Again, this one, the day started off, I think, in Europe with a rally in risk. So stocks moved higher, euro and pound moved higher against the dollar, and that's just moderated slightly in FX markets. In indices, that's reversed, as we've seen, but FX markets still arguably hanging on. And you can understand why for euro dollar, particularly because the ECB is still officially committed to more rate hikes, whereas the Fed, though it's left the door open, doesn't really say it with much conviction, I think. It's still trying to send a message that essentially says we're not officially on pause, but we can't say it in so many ways, so we have to try and make it look as if we could raise rates again. That's, I think, kind of where we are with the Federal Reserve at this point. Anyway, looking at the price, again, after the size of the move on Thursday, that huge rally in euro dollar, it's still very much just a consolidation. And I don't think you should be too frustrated. If you're long this and just seeing it consolidate, I don't think you should immediately decide that it's going to reverse and go and give back all these gains from Thursday. In the short term, if it goes back below 108.60, that would be a negative development, certainly, and have people worried. But the uptrend, as you can see on the hourly chart here, still more or less, still very much intact, has to be said. Below 108.80 as well would be a slightly negative sign because it would lose trendline support in the short term. So that's something to watch out there for euro dollar. For the pound, it promises to be an interesting week. Of course, CPI tomorrow and the Bank of England on Thursday. So again, given the size of the rally in the pound against the dollar over the course of the past week, around about 300 points here, you do wonder what the BOE could say to really move this one higher in the shorter term. There's always a possibility. If CPI comes in stronger than expected tomorrow, it's expected to moderate on both the year-on-year and month-on-month figures. So if it were to be stronger than expected, that would boost the pound. And certainly the BOE, if they were much more hawkish, might lift the pound. Uptrend very firmly intact, but just looking perhaps a little overextended in the short term ahead of these big events this week. You could go all the way back down towards 126 and still test trendline support from those May lows and still be firmly in uptrend. Of course, higher high clocked up over the course of Friday into Monday at around 128.40, the highest level there for the pound against the dollar since, is thinking in public, 25th of April last year. So remarkable recovery here in the pound. We'll just wait to see really what that does in the short term, whether the Bank of England can indeed support it or whether we're due some profit taking at these levels. And then finally, dollar yen, again boosted by the Fed half-heartedly leaving the door open to more rate hikes. I think that's why you saw the dollar weaken against the euro and the pound and strengthen against the yen, of course, because risk on, essentially, when you talk about risk on, you see the euro and the pound move higher against the dollar and the dollar fall. But for dollar yen, obviously, it's the dollar rising and the yen tends to fall because the yen's more the risk averse currency here. Again, the BOJ not really saying much either. That's the key thing from Thursday into Friday, the BOJ leaving things as they were. So that's why we didn't have much of an impact in that either. Still firmly up on where we were on Thursday and Friday. So I think, again, consolidation is the name of the game in FX markets. But it's interesting that you're finally getting a golden cross. That will get everyone very excited in dollar yen, which is often viewed as a bullish signal. The warning here, of course, is that it often reflects what move has happened. And for there, we look at the death cross, as they call it, where the 50 crosses below the 200, a very dramatic name for something that isn't really dramatic, because it simply reflects the fact that the price had already declined into December. And if you'd sold it on the day of the death cross, you'd have been in profit for a couple of days, then moved to break even, and then you'd have been stopped out because the price then rallied. So it's not always, it's a sign that the trend might be shifting, but it's not a sign to go blindly on shorting it. In the same way that this golden cross here that we're going to get today, tomorrow, is not a sign to go blindly long dollar yen. It might be that the trend is now shifting once again back in favor of the US dollar after this 6 to 8 month consolidation, really, in dollar yen. And looking at commodity markets, oil prices still looking stronger, continuing their move higher for another day, recovery from the lows. Whereas looking at gold, it's just a very tough one at the moment. You can feel the frustration for both buyers and sellers, because buyers firmly defending this area here, really. And again, it really is an area, because last week we saw it briefly dip below 1930, but close back above it. And it really doesn't want to go below the 100-day moving average. You can see that there, whether it's coincidence or it is a firm defense of that level, essentially doesn't matter. But the price isn't able to move lower for the time being. So the buyer's holding on this one for dear life and trying to carve out this higher low. We keep thinking they're going to do it, and you get moves higher in the day, only for them to be knocked back or just go no higher, as we saw earlier in June. And that's dominating at the moment. Unless we're back below 1930 and lower, it's very hard to be short-term bearish here, because you've had the pullback, but it's still in an uptrend. So it doesn't really do to argue at this point with that. But as the flip side argument, of course, is that we're not seeing much in the way of upside either. So really, it's a case of, you could range trade this. If you're looking for the trend move, you're probably going to be frustrated in the short term. Back above 1965, and then ideally back above 1918, you might argue that the consolidation has run its course, and we could be seeing another leg higher for the time being. So the buyer's still just about in charge on this one as well. And then crude oil moving higher for yet another day. It was a bit indecisive yesterday, unsurprisingly, with the US out of the picture for the Juneteenth holiday. It's tough. Trading crude oil is really hard at the minute, in a sense, because it is still in a downtrend, but it's not really giving you much in the sense of moves to the downside. Yes, you had that in April after the last OPEC cut, but once again, the most recent cut earlier in June, I think it was June or into the end of May, delivered another cut, but just not a very strong one, and so it didn't really do enough to drive expectations either way. The price is still below the 50 and the 200 and the 100 and indeed the 200-day moving averages, so arguably we're still more leaning into the bear camp at this point. And it has to be said that the price since early May has shown a notable reluctance to get on above $74 a barrel. So until that changes and it's back at 76, I think you'd have to be a bit more cautious about the long view here. It's just that we're still seeing buyers firmly defend this one in the zone around 68. So until that changes, then really it's stuck in a battle of attrition between the two, and you expect that to be fairly frustrating for both sides, I think. Looking at the rest of the day, I think US housing starts and building permits on the calendar later today. We're expecting the Dow to open around about 34,168. Now that's after yesterday's holiday. Dow, of course, was closed, so we finished up on Friday around about 34,300. So we're down about 140 points still from Friday's close on Dow in the cash market. So we'll see whether there's any strength for that one to move higher in the medium term. But I think we'll probably see a fairly lackluster day of trading, even with the US back action, because of the fact we're waiting for what Powell says tomorrow, and that will be the key thing that drives markets, particularly in the US. So that's it for me. Thank you for joining us. We'll be back tomorrow as normal at 10:30.